Now, let's talk about controlled leverage. Let's say that you need to buy something that was $50,000. Now, whatever that something is up to you. It could be a car, could be a rental property, it could be a down payment on a primary home, it could be a loan to your business. I mean, whatever the and is, that is totally up to you. Now, the only thing that's going to limit how much money you can borrow in your policy is how much money that you have inside your policy for cash value. So in this example, in order to borrow out $50,000, you're going to need to have $50,000 of cash value. Now, when you get to this point, you have a couple options. You could just pay the person in cash or whatever it is. You could borrow the money from a bank, or you could use controlled leverage. Now, this is going to be very different than either one of those, and I'm going to show you why. Now, for starters, when you borrow money, or this $50,000, you're not borrowing it from your policy, you're borrowing it from the insurance company. And this process is going to be very different than any other time you've taken a loan. For example, when you borrow money from a bank, they're going to want to run your credit. They're going to know how much income and your assets, what you are buying, and they're going to be the ones who are going to determine the terms of the loan. This is going to be completely different. In this case, the insurance company is not going to run your credit. They're not going to ask you for income. One thing they're really going to want to know is, where do you want the money sent? The reason why the bank is so nonchalant about this is that your policy is used as collateral. Oops. So what that means is that your money is still in there. You're actually borrowing money directly from the insurance company. Because insurance company is just like banks. They need to have their money in motion. They need to invest it somewhere to creating cash flow. One way that they will do that is through policy loans. And the reason why they're not going to bother you about repayments, because to be honest, it's not a big deal if you start paying that back. Why? Because the insurance company will get paid back because they have a lien on your policy. And if you do not pay it back, the interest on that loan is going to continue to accrue. And upon your death, the death benefit is going to wipe off all loans, and then the rest will go to your estate. Now, because you're not going to get a statement, and they're not going to ding your credit if you don't pay it back, that can be good, but that can also be bad. I don't know if anybody here is a fan of Spider-Man. As a kid, I was, but the movies just really didn't float my boat. But there is a scene that I thought was very important. And this is at the beginning of the movie, and Uncle Ben is shot, and he's dying on the sidewalk, and Peter Parker comes to his rescue. And hopefully this isn't ruining anything, but Peter Parker is Spider-Man. And it's too late. Uncle Ben is going to die. And at that moment, Uncle Ben puts it all together, and he realizes that Peter Parker is Spider-Man. And he gives them some very important advice. He says, with great power comes great responsibility. So you have a lot of power of paying yourself back, and you need to be a financial Spider-Man and make sure that you pay yourself back. And when we do the math and I show you the examples, I'm sure you're gonna see why it is important for you to pay yourself back. Now, what's going to be different here is when you borrow from the insurance company, that is going to be a simple interest. Now, you are going to have to pay them 5%. Because remember, I said we're using the insurance company's reserves, or not the reserves, their investments. So they need to put that money to work. So you're going to have to pay them 5%. And you might be saying, well, why would I pay to borrow my own money? But you're not borrowing your own money. You're borrowing money from the insurance company. And if you let me explain the whole story, you're going to see how powerful this can be. So let's take a look. Again, this is going to be simple interest. If we pull out one of my fancy calculators, this is a loan calculator. If we do $50,000 at 5% for 60 months, now your payment is going to be $943 a month. And here's one of the cool things is that you don't have to pay that amount. That's totally going to be up to you. There was a time a few years ago when I had my CPA firm when cash was very tight. And then I realized that, you know what, I have the power to skip a couple of my car payments. I need to be a superhero and make sure I pay myself back at the end. But what that did is that freed up some cash flow. Not only did it make my business a little more efficient, but it also made me a lot more pleasant as well. And being able to have that ability to manage my payments really took a lot of stress off of me. Now for the loan, this loan is simple interest. And that means the interest is going to get lower and lower with every payment. As you can see, that first month, the interest is $208. But we go down to the last month and it's only $4. Now, no matter how long you decide to pay back the loan, the numbers are still going to work. So what you're probably saying is, wait, Anthony, this cost me $6,614. And it did, but let's look at the whole story. Now, again, this is simple interest. And if you look at this triangle, the reason why I put it upside down is that this reflects the amount of interest. You pay a lot at the beginning and very little at the end. But now remember, so we paid that $66.14 to the insurance company. Now, remember, we pay it to them because our money was still compounding. It was still working for us. And that money is still going to get a guaranteed return plus dividends. Now, let's say that that is 4%. And you're probably thinking, whoa, Anthony, wait a minute. Not only do I need to pay 5%, but they're only going to pay me 4%. I'm going to lose 1%. Now, bear with me here. If you remember when we talked about the last webinar, is let's not focus on the rates, let's focus on the return. And I like to say that we do the math. So let's do the math. If we have $50,000 in an account, it'll be 5 years, and we're only earning 4%. Now what you're going to see, this is what we earn the first year. And you notice that each year, the amount we earn goes higher and higher. So at the end of the time, we made our growth of $10,833. So now does it sound to make more sense? This is an example of how compound and simple interest are complete opposites. Again, with the triangle, now the interest we earn gets little at the beginning, but at the end it gets even larger. So we had a cost of $66.14, but our policy grew by over $10,000. That is a profit of over $4,000. Now, let me just kind of summarize that. We had a loan at simple interest at 5, and we had money compounding at 4, and we made $4,000. Now, did you have to work any harder? Did we change your cash flow? Did you take on any more risk? The answer to all of those are no. This can be the power of controlled leverage, because your money is doing two things. Not only did it finance your and that you wanted to purchase, but it continued to grow. It was compounding continuously. We never broke the compound interest curve. Now imagine if we took this a little bit farther. What if we took this out 30 years? Now that instead of having $50,000, now we have over $162,000. That's the power of compounding interest. Can you think of some things that you continually buy or spend money on? And what if you could had a system and we're using a product where that money always continued to compound? We never broke that compound interest curve. Now, some people might be saying, well, couldn't I just do this using a bank? Yes, you could, but every time you take money out, you're breaking the compound interest curve. Somebody could say, well, you know what, that's only 4%. I can earn much more in the market. Maybe you could, but you're going to have to take on more risk, right? And there's also going to be fees and taxes. In that next video, the third piece, we're going to show some examples of what average investors actually make, and it's going to be a little disheartening. So in summary, compound interest works the exact opposite of simple interest. Compound interest, you're compounding on a higher amount, but on simple interest on the loan, each period, the interest that you are paying is lower and lower. Now, using this system allows you to make all of your financial decisions more efficient. This is the most powerful financial strategy out there because it allows you to use your money for short-term and long-term needs without ever breaking the compound interest curve.